This LOS is Explain Principles of Technical Analysis, its applications, and its underlying assumptions. Technical analysis has been used by traders and analysts for centuries, but has only recently achieved broad acceptance among regulators and the academic community. Some applications of technical analysis are subjective. That is, although certain aspects, such as the calculation of indicators, have specific rules, the interpretation of findings is often subjective and based on the long-term context of the security being analyzed. This aspect is similar to fundamental analysis, which has specific rules for calculating ratios, for example, but introduces subjectivity in the evaluation phase. Technical analysis, definition and scope. The underlying logic of technical analysis is simple. Supply and demand determine prices. Changes in supply and demand can cause changes in prices. And finally, prices can be projected with charts and other technical tools. Principles and assumptions. Technical analysis can be thought of as the study of collective investor psychology or sentiment. Prices in any freely traded market are set by human beings and their automated proxies, such as computerized trading programs, and price is set at the equilibrium between supply and demand at any instant in time. Various fundamental theorists have proposed that markets are efficient and rational, but technicians believe that humans are often irrational and emotional and that they tend to behave similarly in similar circumstances. Technical and fundamental analysis. Technicians focus solely on analyzing markets and the trading of financial instruments. Fundamental analysis is a much wider field encompassing financial and economic analysis, as well as analysis of societal and political trends. Technicians analyze the results of this extensive fundamental analysis in terms of how it affects market prices. A technician's analysis is derived solely from price and volume data, whereas a fundamental equity analyst analyzes a company and incorporates data that are external to the market and then uses this analysis to predict security price movements. A key distinction between technical analysis and fundamental analysis is that the technician has more concrete data, primarily price and volume data, to work with. The financial statements analyzed by fundamental analysis are not objective data, but are the result of numerous estimates and assumptions that have been added together to arrive at the line items of financial statements, professional judgment in accounting. Even the cash line item on a balance sheet is subject to corporate management's opinion about which securities are liquid enough to be considered cash. And that's the last slide for this LOS. Thank you.